Hello everyone, it's Elliot Gu here with the Free Market Speculator and the Energy Bulletin, and welcome to my Sunday Deep Dive. In this weekly video, we look at a key chart, trend, or indicator that caught my eye over the past week, and I explain what it means, or at least what I think it means for financial markets. Now, in last Sunday's deep dive, we started with a simple question I've heard posed in the mainstream media and by viewers and readers a great deal in recent weeks, and that's this, why aren't oil prices much higher than they are right now? After all, despite the ongoing disruption through the Strait of Hormuz this summer, West Texas Intermediate and Brent oil prices closed last week at $84.67 a barrel for WTI and $90.12 a barrel for Brent. So those are actually the front month futures prices, September futures in this case, in both cases. And as you can see here on my chart, that's much higher than late last year when prices were closer to $60 a barrel, yet it's far below the highs we saw well over $110 a barrel this past spring. Now, we covered a lot of ground in that video last week, including a deep dive into refining profit margins known as crack spreads. We covered China's import strike, US and OECD, that's developed world, strategic petroleum reserve releases, and Saudi and UAE, United Arab Emirates, workarounds to bypass the Strait of Hormuz. So I'll link to that video below for those of you who might have missed it. This week, I decided to build on last week's video to answer a second common question I'm frequently asked and hear debated in the media endlessly. And that's this: even with oil prices in the 80s and 90s, rather than $100+ a barrel that we saw earlier this year, they're still well above the break-even prices required by major US shale producers to generate significant free cash flow. So, won't US oil production from fields like the Permian just take off and push prices down again by oversupplying the market? In their zeal to relate every economic question to US national politics, you'll often hear the mainstream media frame this question in terms of a popular slogan from the 2024 presidential campaign, and that, of course, is "Drill, baby, drill." The notion that President Trump promised to unshackle US oil companies and encourage them to drill more aggressively. So, doesn't that mean a surge in US oil production, similar to what we saw back in 2013 and 2014, is just around the corner and that prices will soon collapse? Well, let's dive in, starting with this. This is a chart of total US oil production by month since August 2023. Now, it's data from the Energy Information Administration, the EIA, their monthly petroleum market report. The latest monthly data we have is for May of this year, and that report was just released last week on Friday, the July 31st. Now, in May 2026, US oil production was 13.714 million barrels per day. Now, as you can see, that's actually down from an average of 13.823 million barrels a day in the months of August through November of last year, 2025. So that's a decline of a little over 100,000 barrels a day, despite the surge in front month West Texas Intermediate crude oil prices over the same period. As you can see here, front month oil prices averaged around $61.80 a barrel from August through November of 2025. And compared to that, in May of 2026, this year, after the start of the Iranian conflict, prices for the same benchmark average about $98.50 a barrel. So that's an increase of about 59%, an increase of $36.72 a barrel. Big move. Yet oil production was lower in May of this year than it was in every single month from August through November of 2025. Look at this chart again, and you can clearly see a big drop in January oil production which was caused by Winter Storm Fern, you may have heard it called, and that was a major cold snap that prompted power outages, well freeze-offs, and refinery disruptions all along the Gulf Coast, as well as other places. So we recovered from that amid the spring thaw as the temperatures rose. However, apart from that weather-related variability we saw earlier this year, there's been zero discernible growth in US oil production since late last year, despite a near 60% surge in oil prices. So why isn't US oil production rising as American shale producers seek to take advantage of the surge in oil prices. Now, there's several factors at play here, but I'm going to focus on just three today. First up, oil prices never actually rose over $100 a barrel this spring, from the perspective of the companies that actually produce and sell oil. I'm talking about the shale exploration and production companies. They never really experienced $100+ oil. Now let me explain that. As I said, the current front month West Texas Intermediate oil futures contract, well, it closed on Friday at a little under $85 a barrel. Now that's the price you hear about most often in the media, financial media too. However, here's the real picture. This is what's known as the futures curve. You see, the front month WTI futures represents the price of WTI per barrel for delivery right now in September 2026, right? However, I can just as easily trade futures or options to contract for oil delivery in December 2026, or even August or September of 2027, a year from now. These contracts trade at very different prices to the front month. Specifically, you'll see that the WTI oil futures curve slopes down right now. And that's a condition we call backwardation. And if I want to buy or sell WTI for delivery in December of this year, it's trading at a little over $76 a barrel. And if I go out to April to September of next year, that's next spring and summer, right? Prices are in the low 70s a barrel, ranging down to the high 60s per barrel. That's a full $15 a barrel discount to where the front month is trading right now. Now this point is crucial. The futures curve doesn't really tell you where oil is headed. In fact, the futures curve is terrible at forecasting future oil prices. But this does not mean that oil is going to fall to $70 a barrel next summer. However, it does tell you what market participants today are willing to pay for oil in December 2026 or June of next year. More importantly, if you are an oil producer, it tells you the price at which you could hedge future planned production. Now put yourself in the shoes of an oil producer in the Permian, trying to decide if you want to spend more money today, capital spending or CapEx, to grow production into the middle of next year. You're thinking about contracting another rig to drill some of your prime acreage in Texas. You want to schedule additional crews to hydraulically fracture wells. Maybe you're thinking about capital spending budget for midstream infrastructure like a fracturing water recycling system, or contracting with a pipeline company for capacity on a pipeline to move your oil or associated natural gas production from West Texas to the Gulf Coast. The problem is that spending decisions that you make today influence your production in late 2026 or early 2027. And given how volatile oil prices have been lately, you're worried that you could spend more to increase production today and then bring that oil to market when prices are lower, much lower than they are today potentially. You're worried that you'll boost your cost structure and not be able to generate as much money for those new barrels as you might have hoped. To put it mildly, your shareholders wouldn't be happy about that. You'd probably get some nasty questions from analysts on your quarterly earnings calls next year, implying that you've lost discipline or are wasting money and sacrificing shareholder returns or even dividend sustainability. One common solution to this for many producers is to hedge a portion of their planned production immediately to lock in prices for, say, Q1 or Q2 next year. You could buy put options on WTI oil, or use what are known as options collars to guarantee you a minimum price for the oil you're planning to produce early next year. Or you could go over to a major financial institutions like, for example, Goldman Sachs. And you could buy an over-the-counter swap contract, which would lock in a specific price for your production through Q1 2027 or even Q4 2027 if you want to go a little farther out. That way, if you bring more oil to market, and prices drop, your shareholders will have some of that return guaranteed, and they won't be quite as angry as they would have been otherwise. So what does the futures curve does for us is it tells us roughly the price at which a company can hedge planned production in the future. The price at which a firm can lock in planned production for next year to help give some clarity on returns from money invested. again, capital spending or CapEx budgets, that you might make in the next quarter or two. So while many in the media or casual oil market observers, they look up and they see 85 or 90 or $100 a barrel oil, the company's actually making decisions to drill or not to drill, decisions that will determine if U.S. oil production is up next summer by 250,000 barrels a day, flat, or down. Well, their decision-making process is anchored to that $70 a barrel price point on the futures curve I just showed you. They might make some decisions to accelerate well completions a little bit this summer or fall, or they might make a decision to shift their drilling activity to a more oil-rich part of their play and their main areas of operations. But these are tweaks to produce a little bit more crude in the current quarter or next quarter and to take advantage of those higher prices. They aren't the sort of moves that are going to change the picture for U.S. oil production growth over the next 6 months or year or 2 years. And while the degree of backwardation in WTI today is sizable, it was even bigger earlier this year. Just consider that on April 7th, 2026, WTI, well, it closed at $112.95 a barrel. And that was the year-to-date closing high for front-month futures this year. So that's the blue column here on the left-hand side of the chart that I'm throwing up on your screen. Now look at the red bar right next to it. At the close on April 7th of this year, the Q4 2026, the fourth quarter 2026 calendar strip. Now, that means the average price of WTI oil futures for delivery in the months of October, November, and December of this year. So that's Q4. Well, that stood at just $76.39 a barrel. The price at which you could hedge Q4 2026 production in early April of this year was more than $36 a barrel lower than the front month price of WTI, quoted endlessly and breathlessly in the mainstream media. Today? Well, today, as I said, the front month price of oil is $84.67 a barrel. And the Q4 2026 calendar script, well, it's actually a bit higher than it was back on April 7th. It's trading around $78.86, just a little under 79 bucks a barrel. Yeah, that's right. If you're an oil producer, you can actually hedge your fourth quarter 2026 production today at a higher price than you could have back in early April when oil was supposedly trading near $113 a barrel. Do you see how that works? Now consider this in light of the elevated refining profit margins, the record high crack spreads we're seeing this summer. Now that was a topic of last week's Sunday Deep Dive. As I explained, refiners don't make money from rising oil prices. Indeed, an independent refiner like Valero Energy, for example, they must buy oil as feedstock for their refineries. It's a cost center. They make money when the prices of refined products they do sell, like gasoline and diesel, rise relative to the price of oil. Now that's exactly what's happening right now. The Chinese oil import strike and inventory drawdown, US and OECD releases of strategic petroleum reserves, these measures all boost supply of oil, and that will tend to push down oil prices. However, they can't change the fact that operational global oil refining capacity, it just isn't sufficient to convert all those oil barrels into gasoline and diesel fuel. These measures push down the price of oil and inflate refining profit margins. But they have a less profound effect on the price you pay for gasoline or diesel at the pump. Now, think of what that means for a shale oil producer like, for example, Diamondback Energy. The symbol there is FANG, like a snake's fangs. And they operate in the Permian. Most of their acreage is on the Texas side of the Permian, specifically the part of this massive shale field we call the Midland Basin. Now, FANG has no refining operations. They're not in the refining business. They're in the oil, and to a lesser extent, natural gas and natural gas liquids production business. So I think a lot of Americans, or anyone really, who only casually follows the energy business, they see the price they're paying at the pump. Right now, according to EIA in the US, that's about $3.95 a gallon on average. Or maybe you live on the west coast of the US in a state like California, and you're wondering where you can purchase gasoline for under $4 a gallon. Well, let me add that in there too for you. The red line is the retail price of gasoline on the West Coast, and the blue is the national average. Either way, Consumers are paying more at the pump today than at any time in the last 4 years, going back to 2022. Now, some people see that and they think that an energy company like Diamondback, well, they must be making a ton of cash. And to be fair, they are doing just fine. But it's important to understand that they're not really getting the benefit of those elevated gasoline prices. That's mainly benefiting the refiners who actually produce and sell gasoline. A company like Fang, they're selling oil, a market where prices are much lower today than they were back in April, and significantly lower than was the case back in the summer of 2022, which was the last time retail gasoline prices that were at levels like we're seeing today. Even worse, as I just outlined, a company like Fang, well, they're looking at the futures curve, not the spot or the front month futures price. And right now, that means they're making decisions based on the fact that they can only lock in prices sort of either side of $70 a barrel for oil they produce next summer. Do you see the disconnect between what the consumer feels and what an oil producer in the Permian sees? Even more important, having a strategic petroleum reserve, SPR, as the US does, it makes a ton of sense. And releasing oil when there's a supply shortfall or disruption, such as we've seen this year, well, it's logical. Yet releasing oil from SPR to bring down oil prices doesn't fully pass through to the consumer or to a business buying diesel fuel or jet fuel, when a good bit of the bottleneck is in the form of refining capacity, not a lack of oil supply. In fact, there's an unintended and negative consequence, right? By pushing down the price of oil relative to gasoline or diesel, or both, you can discourage greater oil production long term because you're depressing the returns for a company like Diamondback, what they can make from boosting capital spending to produce more crude. So that brings me to two related issues. Those are shale producer discipline and US shale maturity. Now, this chart shows you the history of the US shale boom, and it's pretty dramatic. In December 2009, the US produced a little under 5.5 million barrels of oil per day, compared to a little over 13.7 million barrels a day, as I said, in May of 2026. I'd also highlight two distinct waves of growth visible on this chart. First, you had the period here from September 2011 up until December 2014. Over this period, which was a little over 3 years, US oil production soared from a little over 5.6 million barrels per day up to 9.55 million barrels a day. That represents oil production growth averaging about 17.8% annualized, an incredible 1.21 million barrels a day of production growth per year. Over most of this period, global oil prices were pretty elevated, hovering around $100 a barrel. So that supported strong drilling activity and shale economics. Strong oil prices of that era were due in large part, to OPEC's decision, that's the Organization of Petroleum Exporting Countries, their decision to limit their output, limit global oil supply to support prices. Because OPEC, led by Saudi Arabia, cut its own supply growth and supply in some months, US producers, US shale producers, they were able to grow market share and increase supply without having a dramatic impact on global supply and demand conditions or depressing oil prices. In effect, OPEC and Saudi Arabia in particular accommodated the growth in US shale production. You could even say they helped finance shale production growth by propping up oil prices. They rendered shale production more profitable and made access to capital easier for US shale producers who were at that time still learning how to produce oil efficiently from fields like the Permian Basin. In late 2014, OPEC realized their mistake or their miscalculation. Saudi pushed OPEC to commence a pump-at-will strategy, and they flooded the market with supply, driving oil prices down from over $100 a barrel in the summer of 2014 to lows in the 20s per barrel by February of 2016. And low oil prices are what makes this second wave of shale growth here so interesting. Between June 2015 and November 2019, US oil production soared from about 8.7 million barrels per day up to just shy of 13 million barrels a day. 12.998 million barrels a day to be exact, there in November 2019. So overall growth wasn't quite as strong as 2011 to 2014, but still impressive at just shy of 800,000 barrels a day annualized over this 3+ year period. As I alluded to earlier, what did make this episode remarkable is that oil prices only averaged $61.09 a barrel for Brent and $55.84 per barrel for WTI from the end of May 2016 through the end of November 2019. Now here's a chart of that period with the average for WTI over the whole period overlaid as a purple line. So US oil production growth, mainly from shale, was very impressive at 800,000 barrels a day each year, despite far lower oil prices than in the first wave of the shale boom back in 2011 to 2014. So how did shale producers grow production so rapidly in that 2016 to 2019 timeframe, even with oil prices well below the $100 a barrel range that prevailed in the first wave of the shale boom? Well, greater efficiency is part of the story. US shale producers got better at producing oil from shale. Well designs improved, and accordingly their break-even costs, that's the level of oil prices they need to generate positive free cash flow, well, they fell. They could produce more oil at lower oil prices and make more cash than 3 years prior. However, that's only one piece of the answer. The second part is that many outspent their cash flows. That means they spent more on drilling and completing new wells to grow their production than they generated in operating cash flows from producing and selling oil and nat gas. To fund that outspend, they borrowed money, or at a minimum, even some of the better quality, lower cost producers with access to the best acreage, they generated very little free cash flow. Now, free cash flow is a measure of the amount of cash left to a business after they pay all their cash operating expenses and after capital spending, CapEx, which, as I said, in the shale business is mainly money spent to drill and complete new wells. Why? Well, in the early years of the shale boom, during the industry's growth phase, Wall Street valued shale producers based on their ability to grow production, based on metrics like how many barrels of oil or barrels of oil equivalent they produced per outstanding share of stock, and how that changed over time. Now, I remember some years where you could plot a chart with production growth per share on one axis and stock performance on the other over the prior year, and you got a pretty tight fit. The more they produced, the faster they grew production, the more the stock went up, and the more the company was worth. Now, seems a little illogical now, but you have to remember shale was an exciting growth business. It was a new era, and companies were still figuring out where the best plays were, how to design their hydraulic fracturing stages, and which layers of rock under their acreage were more prolific for oil or natural gas liquids. By 2019, this pattern changed. And after the COVID commodity price collapse of 2020, the shale growth at any cost days were over. Investors moved from caring about the rate of production and started prioritizing free cash flow, how much cash the business generated. Or more accurately, investors became increasingly careful about how much free cash flow the business generated to make shareholder-friendly moves like paying dividends, buying back stock, or paying down debt. So the companies also adjusted their strategy accordingly. Rather than targeting a specific level of production growth or providing specific growth guidance, most producers shifted to settling their capital spending with a goal of maximizing free cash flow. So if commodity prices were low, they'd cut CapEx, reduce their rig counts, and allow production to fall, hoping to hold on to as much cash flow as they could by reducing their spending. After all, why produce more oil and gas if commodity prices are low? Why not leave it in the ground, wait for prices to recover, and then produce those barrels when you can do so more profitably? Now, every shale producer has only so many productive, low-cost drilling locations. Sometimes they're called Tier 1 drilling locations. There's an inventory of them. So why burn through that inventory of Tier 1 sites at $50 a barrel when you can wait for better pricing and drill through that well site inventory when it's more profitable and you can generate more free cash flow, make shareholders happy? And when commodity prices were elevated, right, in this era, the larger producers would boost CapEx to take advantage, but the level of production growth they generate was very modest relative to what was common in the early years of the boom, maybe targeting 2 or 3% annualized oil production growth in those boom years. Many would only seek to boost production when they could lock in higher prices going out a few quarters using hedges. Remember, they were looking to lock in free cash flow, again, to please Wall Street and shareholders. Some were faster to see this shift and adjust and did better, and others were slower, but the business became about targeting free cash flow and having production growth as the output of that business model, rather than the inverse of that, setting production growth targets and then spending or borrowing as much as needed to meet those goals. So you can see that shift here. This is the chart of U.S. oil production since 2009 again. As you can see, U.S. oil production collapsed in 2020 as oil prices plummeted amid COVID-related lockdowns and travel restrictions that reduced oil demand. Front-month futures actually dipped below zero for a time. And then when demand and prices recovered, U.S. production bounced back. However, after that initial recovery phase, growth slowed. Just look at the slope of U.S. oil production since the middle of 2022 and compare that to that 2016 or 2019 phase, or the 2011 to 2014 phase even more. I've circled those booms. There is no comparison, despite the fact oil prices were elevated in 2022, early 2023, and then again, as I've explained, this year. Shale producers aren't chasing oil, and in particular, they aren't chasing the front of the curve, front-month oil futures, as they might have just 6, 7, or 8 years ago. That doesn't mean U.S. oil production will suddenly start falling. And it doesn't mean we can't and won't see some gradual growth in output this year or next year over the next 5 years. However, it does mean the U.S. shale business is mature, and we're likely in or near a plateau phase, where production generally starts to level off and trend sideways over time. Listen, one of the first energy-related market niches to report earnings each quarter are the oil services firm, and in particular what are known as the big three diversified services firms. That's Halliburton, Schlumberger, now known simply as SLB, and Baker Hughes. Now these companies work globally, in the US, in the Middle East, in Canada, Africa, and Brazil, everywhere. They do not produce oil or gas volumes. However, they work on behalf of the producers. That could be a supermajor like ExxonMobil, working on a deepwater project in Guyana. A large independent producer like Diamondback that I mentioned earlier, drilling a series of wells in the Permian Shale, or a national oil company like Saudi Aramco, looking to assess damage to energy-related infrastructure and restart fields following a drone attack. They have an unparalleled 30,000-foot view of what's going on in the global energy business. And so I always prioritize listening to their comments and their Q&A posed during their quarterly earnings calls. The one to watch when it comes to North America specifically, and in particular U.S. shale, well, that would be Halliburton. Halliburton is a global business, but they have the most extensive business out of the big three service giants in U.S. shale specifically. As you might expect, one of their primary business lines is fracturing-related services. Hydraulic fracturing involves pumping a liquid into a shale field under tremendous pressure to create cracks or fractures, hence the term, that aid the flow of oil and natural gas through the reservoir rock and into a well. And Halliburton hosted their Q2 earnings call on July 21st, just a couple weeks ago. What really caught my attention were some of their comments about North American shale activity this year in the face of improved commodity pricing. Now, during his opening remarks, Halliburton CEO Jeff Miller stated, and I quote, "In North America, activity responded positively as we expected. Over the long term, North America remains critical to global energy security. I expect the market will require more advanced technology and greater service intensity to simply sustain, much less grow production." Now, as Halliburton went on to explain later in the call, the pickup in activity they saw in the second quarter in North America represented a decline in what's known as calendar white space. Basically, coming into 2026, they had some fracturing and service crews that were not fully utilized for the quarter and the year ahead. The white space, it's just unbooked capacity on their calendar. So what happened is that as oil prices spiked, the remaining space on the calendar got booked by producers. So there is an uptick in drilling activity, and I'd expect some firming in U.S. oil production ahead, even though we really haven't seen it yet. However, look at the second part of this quote. Over the long term, Miller stated that the market will require more advanced technology and more service intensity, meaning more work on the part of services firms, just to sustain production, not grow, just sustain. Now, as I said, Halliburton indicated that they're running out of calendar white space in North America in Q3 and Q4 and beyond. However, they also have some equipment that they took offline in the US when commodity prices and demand were lower prior to this year. They could bring that equipment back to work in North America to meet rising demand if producers were looking to boost activity. During the Q&A session, Jeff Miller had this to say about reactivating equipment in North America. And I quote, "It really comes down to this. It's price first. We're actively working our entire fleet and getting price on that in North America. But we have zero hesitation of moving equipment around the world, whether it be in C&P or D&E, to a place that generates returns for Halliburton. And when there's opportunities, we'll do that." And it's been what you've been seeing on the C&P side, frac with Argentina. You see it in the Middle East, Algeria, UAE. All of these places have been going to a home that makes better margins, better returns for Halliburton. Now, C&P refers to Halliburton's completion and production business, which, as I explained earlier, includes hydraulic fracturing and other services related to shale. And what Halliburton is saying here is that they're utilizing as much of their existing fleet as possible in North America and raising prices when they can. However, they're also moving equipment like their advanced Zeus fracturing system outside North America, where demand and pricing are higher, where Halliburton can earn higher profit margins. Examples include Argentina's Vaca Muerta shale field. This is something I covered at length in a video I posted back in early May. I'll post a link below. Halliburton also mentioned Jafurah and Saudi Arabia. Now, this is not a shale field, but it is unconventional, which basically means that it needs to be fractured like shale and produced using mainly horizontal wells. It's located to the southeast of Saudi Arabia's massive Ghawar oil field, which is the largest conventional oil field discovered anywhere in the world. It's also located at much deeper, much farther under the earth, much deeper in the rock column than Ghawar, and subsurface temperatures are accordingly far higher. So it's a lot more complex to drill and requires more services work. The idea here is to use natural gas from this field to displace oil currently used in the kingdom to produce electricity domestically. So that would free up more oil for export. Now, this field also contains natural gas liquids that are useful in the production of various petrochemicals and fertilizers. Halliburton also mentioned Algeria in North Africa, which recently contracted with them to target some shale gas resources there, which are huge. So my point is simple. There's no flood of new oil production coming from the US to swamp prices. While the US is the world's largest oil producer by far and will remain so for the foreseeable future, shale is no longer in a boom phase. The shale industry is extremely disciplined and focused on generating reliable free cash flow quarter after quarter. They're not chasing the front of the futures curve. What we are seeing is a new wave of global capital spending. It's a new investment cycle, globally driven by a desire to produce more oil and gas, as well as, crucially, energy security and the desire to reduce reliance on a single supplier, a single source of imports. For this to make economic sense, we're going to need to see oil prices generally trade at higher levels in coming years. That's good news for quality US shale producers who will generate significant free cash flow and pay dividends, buy back stock. And it's also great news for the services firms in particular who participate in all of this exploration and development work, whether it's onshore shale or deep water projects. They're the companies that have the technology. Thanks for listening. I hope you enjoyed this week's Sunday Deep Dive. If you enjoyed this week's video, please drop me a like or a comment. And you can subscribe for free to make sure you receive this weekly video and my other posts and updates when they're released. And if you'd like to give the paid tier of Free Market Speculator, including our popular Energy Bulletin Top 10 Model Portfolio, if you'd like to give that a test drive, I am offering 14-day free trials via the link below. In the EB Top 10 portfolio, we recommend the exact producer and services stocks we like to invest in the next wave of this energy supercycle. I'll see you next week for another episode of my Sunday Deep Dive. Thanks again.